In this week's update, caught in the middle, neither trader or investor. In a cyclical bear, everything gets hit eventually. We're not there yet, but we're getting closer. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Now, I'm recording this on Saturday afternoon, so prior to the finalisation of the Australian election result. So I'll have more to say about the Australian election and the impact on our markets to members on Monday. So at this stage, I don't know which way it's going to go, and whether we're going to have a hung parliament or what the heck we're going to have. Let's start with the market perspective. The bearish signs continue to intensify, and that's a good thing because it means that the more and more bearish that the market becomes, then the closer to the bottom that we get. So please see that as a positive, not a negative. Just a couple of examples. There's many things that I could have highlighted here, but just a few that I think are relevant. The US funds cash holdings are now the highest in 20 years. So fund managers are turning pretty cautious as well, and that could well be because they're getting redemptions, and so they've had to raise cash levels to accommodate those redemptions. Also, there's no sign yet that the rate of increase of inflation is slowing. I'm a bit surprised by that, but I guess it's supply chain issues, it's issues around energy and food prices as a result of the Ukraine situation that is exacerbating the inflation. But we're not seeing a slowing yet, and I think before we get to the bottom of the market, we need to see a slowing. Inflation can still increase, but it needs to increase at a slower and slower rate for the market to take notice. At the moment, it's still accelerating. There's also been a movement into bonds. Some people are buying bonds. Seriously, why would you want to be buying bonds at this stage with inflation breaking out? You're locking in a really poor yield, and you're going to suffer a capital loss as well if you have to redeem your money before the end of the bond period. So this is one of the worst times to be buying bonds, yet people are doing it, and that's an indication they're so fearful of the equities market that they're prepared to take that risk. They see that risk in the bond market as less than the risk in the equities market, and again, that's a good thing because it'll reach an extreme, and equities will definitely become a buy again. These data points are similar, but there's some contrarian bullish signs emerging as well. The put to call ratio is finally getting to a level of bearishness that is more representative of a market bottom. So that's a positive, because when it reaches an extreme, then it means that nearly everyone's fearful, and people are bailing, and the smart money's going to start buying, and that's going to be the low of the market. So that's an emerging bullish sign. And also, as I said, the bond yields are dropping as the data gets worse. And that makes absolutely no sense at all. That's completely illogical. So there are a couple of positives. Now, if we look at, let's just look at the equity put to call ratio. So this is not total put to call. This is just on equities. And this is going back to 2018. So if we look at the end of 2018, we had a spike that was associated with the last time that the Fed was tightening, and they had to back away from it. And you can see we got up to about 0.8, which is about where we are now. This is the COVID crash. So the equity put to call ratio got to 1.2. Now bear in mind, this is end of day data. There's intraday spikes just in the last week or two that have gone as high as 1.5 on the put to call ratio Might only last an hour or two, but nevertheless, there have been some very, very big spikes. So we're at least at a level that is more like a low in the market. So that's the positive there. This is the other one that's really interesting. So this is the yield. Let's put the yield on. Let's look at the last 3 months. So we reached a peak. There was an intraday peak around 3.15, and we've now backed off to 2.79. Even though the data gets worse and the inflation numbers have shown no respite in moving higher. So these are all signs that we're getting closer to the lows. All right, what to look for? I've covered this a couple of times over the last few weeks, so this is just a bit of a recap. We need to see a capitulation washout in the markets, and I am not seeing that yet. Not in America, which is really where I take my main cues from. There hasn't been that real washout, that real fear come in the market. The big tech growth stocks are now really starting to get into gear and to the downside. So we're getting closer to it, but we haven't had that real capitulation washout yet. We need to see a robust swing back to growth stocks, and when you look at the ratio spread charts that I'll show in a minute, it's still not there. We need to see the rallies being broad-based, so we need to see small caps, mid caps and large caps in the growth areas all back into uptrend and outperforming the more defensive sections of the market. And until we see that, I don't believe we've seen the lows. It's very easy to just consider the data points or the charts that you rate as important and to forget the rest. That's how our mind works. We just zero in on the things that we think are relevant and important or that support our view of the world, and we tend to dismiss or not go looking for the other areas. But it's just so critical to consider all the key elements, because otherwise you're going to arrive at the wrong answer. And I've had a number of emails in the last few months from people, complaining almost that, how can this be? What's happening in the market is completely illogical. And it seems illogical to them because they've only considered part of the equation. And the most important thing that you can do is to remain open-minded at all times. Consider as many of the data points as you can. Stay open-minded. Don't worry about what's logical. Just go with what the money flows of the market are telling you, and that's what I try extremely hard to do. I guess the other point, and this is probably straying back into a bit of logic here, but I think I'm on pretty safe ground on this one. After what they've done since 2008, and particularly since 2020, does anyone really see central banks hiking us all the way into a significant recession? I can't see them doing it. They've worked so hard to keep economies out of recession and to recover them from recessions that we had in 2008 and in 2020. I just can't see the US Fed just going, up and up and up and push them all the way into recession. I think they're going to back off. And I covered this a fair bit last week. So if you didn't get to see that video, I think that's an important perspective as well. I want to show you something on the Wesfarmers chart that I highlighted a number of weeks ago. But just before I do that, let's just go in and look at this question of getting caught in the middle. And I'm just using Microsoft here as an example. And I know that a number of people have been caught in this situation. They're neither a trader or an investor. And the difference in my mind is a trader should be entering at a key level of support and have a tight stop loss underneath it, the trade either works, it goes up, or it doesn't, and it fails, and you get out. That's what a trader does. It's cut and dried. You get in here, and if it fails, you get out there, and that's it. Whereas an investor can be using fundamentals, can be using a combination of fundamentals and technicals, but they have a different trade structure or a different rationale for what they're doing. Yet I reckon a lot of people, and I've got pretty good evidence because I'm in a unique position where I get to talk to and see what a lot of people are doing and thinking. And I think a lot of people get caught in the middle. And just as an example, and just kind of examine your own actions here. So if in the first instance, if we put a trader's hat on, so I'm a trader, and I'm buying at $280 for Microsoft because that looks like a reasonable level of support. We've got plenty of reversals at that level. So I buy at 280 support and I put a stop loss somewhere just underneath it, maybe 270. So if the support level holds and the price goes up, it's all good. If the support fails, then I'm out and I've taken a small predetermined loss. But what a lot of people tend to do is that they fail to take the tight stop loss because they didn't really believe that Microsoft's support would fail. And so they convince themselves that it's just temporary. Now, I don't know where Microsoft is going to finish up, but at the moment, you can see it's quite clearly heading down, and the little bounce we got at the start of the week didn't get them anywhere near the 20-day moving average. So this is quite now a concerted downtrend. And so now this trader, if this is the way that they've responded, is now caught in the middle. On the other hand, a lot of people have got an investor's hat on, and they might buy at $280 thinking that's a good entry point and I'm going to sit on Microsoft for the long term. And I know that this is happening because I'm getting the feedback that the news is just so bad and the price action looks so awful that there's a bit of a panic sets in and they sell, even though they started off thinking, well, I'm going to buy at 280, I'm going to sit on it for the next 3 to 5 years and that's that. But circumstances change and they get out. So a lot of people get caught in the middle between being a trader and an investor, and they flip-flop from one to the other and they get themselves in a heck of a mess. And it really gets back to the clarity of what you're doing in the market and staying the journey with what you're doing. Now, the other point, the other point that I want to make here is just some of the bearishness that convinces me that we've not got to the bottom yet. So there's the chart of Microsoft, and you can see quite elevated volume on Friday. Let's look at Amazon. 2 levels of support here, one here at 21.59, the next one at 20.25. And we've basically bounced off both of them in the last week or two. But you'd have to be a very, very brave person to say that this is the low and that this level just around 2030 is going to hold. Now, it may do, but you'd be very brave to make that call at the moment. So I'm not sure that Amazon or Microsoft or Google, which I'll show you in a minute, have reached the bottom. And therefore, if they haven't reached the bottom, then the indices have not reached the bottom. I can assure you of that. This is Google. So we've got a possible support level here, but in a cyclical bear market, support levels tend to break. That's the reality. In a cyclical bull market, support levels tend to hold and resistance levels break. But in bear markets, the opposite happens. And so there's every chance that this level will break. And in a cyclical bear market, it's more likely that Google will retrace to at least the 50% level and often the 61.8% level, which is down here at 1800. Now that could be another nearly 400 points down, or $400 down, I beg your pardon, on Google. So these are all the reasons, plus the spread charts that I'll get to in a minute, that convince me that the odds are we haven't reached the bottom yet. But we could get there quite quickly, and you've got to remember that some stocks will start going up before this process is over. And some stocks have been going up. So, don't think that this is all embracing, that all parts of the market are going to continue to fall from here. It's just sentiment is going to be a bit negative. Now, this is the final one that I want to show in this little. Oh no, it's not. There's one more, but I want to show Tesla. Now, in Portfolio Analyst on Wednesday, I said that I'm still looking for the big multiple contraction in Tesla. We're seeing it in Amazon and in Microsoft and now in Google. Tesla, why should Tesla be immune from a big downside move? And the answer, that you obviously get is, well, it shouldn't be immune. Now, that was a couple of days ago when it was still sort of hanging around this sort of 800 level. Using the 2020 to 2024 actual earnings results and the forward estimates, I came up with a compound annual growth rate over that 4-year period. So that's 2 years of actuals and 2 years of forecasts. And the forecast growth is pretty robust. So I get a compound annual growth rate of 61% per annum over that 4-year period. But if you look at $800, based on the forecast financial year 2022 results, that has Tesla trading on a PE of 68 times and a revenue multiple of 8 times. Now, in this market, that was fine in 2019, 2020, 2021. The market was prepared to do that with Tesla and with a lot of other stocks. This is a different market, and that market may not return for a long period of time. And it's just not going to happen that a stock like Tesla or any other high growth, high multiple stock is going to hold up in the face of the current market sentiment. And as I said in the opening slide, eventually high multiple stocks, the market's going to get you. It's going to get everything. And Tesla is now showing the signs of breaking down. And you can see we had quite a robust bounce intraday in the S&P on Friday night. But look at Tesla. That's a pretty convincing breakdown. Look at the volume. Volume was right up. So there's another box ticked. And finally, this is XRT. This is the retail ETF in the States. It's in real trouble. And you've got stocks like Walmart getting absolutely smashed. So a lot of pain in the retail space in America, and we're seeing a similar thing in Australia as well. Now, I'll finally take a look at the Wesfarmers chart. So I put this up, I don't know, probably 4, 5, maybe 6 weeks ago, and you can see here that we didn't have a lot of earnings growth to get excited about. The compound annual growth rate from 2016 to 2023 was only 5%. And at the time, I think we were back here somewhere, Wesfarmers was sitting around about $50, but clearly in a downtrending channel. Now, a lot of commentators and brokers were still calling Wesfarmers as a good buy at the time. And my view was, just based on what I'm seeing with the overall market and with the fact that we were still trading on a 2022 PE of 26 times, I said at the time that is just too high. And that in keeping with the technicals, that it was almost certain that Wesfarmers would continue to decrease. And that's in fact what's happened. And now we're starting to get closer to this 18 times PE of 37.80. We're not there yet. It's still at 46.75. I could see Wesfarmers getting down to this level based purely on the multiple contraction that I'm seeing around the world. All right, bit long-winded, but I guess I really want to make the point that things that you may not be expecting to happen are happening, and they're going to play out, come what may. So, I think everyone needs to have their eyes open. A conservative stance is just smart at the moment. You need to be very clear, are you a trader or are you a long-term investor in absolute quality assets? And if you own, Microsoft, and providing you didn't buy somewhere near the peak, if you own assets like Microsoft or Google, then they're going to be great long-term assets. Don't get caught in the middle. And I've gone through that exercise of what does that look and what does it feel like. So if you're getting caught out, then you really need to examine, what hats you're wearing. So what should an investor do? Let me try and be a bit proactive here. If you are being caught in the middle, then what should you do? Well, I think the days of buying speculative growth stocks, unless they're in mining and they've got a really, really solid resource and a really solid case for being significantly higher in a year or two's time, then you really should be only buying high quality, high conviction stocks. Now, where does that conviction come from? To get a high conviction about a stock as an investor, what do you look to? Do you look just to fundamentals? Do you look at the technicals? If you look at either of those, how broadly do you look at that data, or are you only just picking the data pieces that sort of suit you? And maybe that's where you're not as convicted about the stock as you should be, and that's where the indecision and the flip-flopping comes from. What should you do as a trader? Well, in my view, you should only buy deeply oversold at likely support and have a tight stop on it, so that if it fails, then you only lose a little bit, you get out and you execute it diligently and you move on and you wait for the next opportunity. All right, let's look at American stocks. The S&P ended up falling 3.1% for the week, but it was a pretty robust rebound in the last couple of hours. It was a very large range, 6.8% for the week. So the volatility is really up there at the moment. Large cap growth, as we saw, it's now in full retreat, and I think there's definitely more downside in those stocks. Waiting for all the data points is paying dividends. If you've been watching these videos over the last 4 or 5 months since the start of the year, and you've been following the data points with an open mind, then it should be really paying dividends for you. Yes, we got a bit of a feint in the middle of March where we got a 3-week extremely robust rebound into growth stocks. And sometimes the market just trips you up. And, that's it. You can't avoid it. You're never going to be right all the time. But as long as you then shift your position back again quickly, I turned bullish in the middle of March. I gave it a week because it was associated with options expiry. I didn't really like the rebound at the time, and I said so, because to me the market hadn't got bearish enough. We hadn't seen big tech break down, but now we are, and so waiting for that, those data points is certainly paying off. The US index slipped to 103, got up to 105 at one stage. The 10-year yield we've looked at, the VIX peaked at 33, but finished just under 30 with that bit of a rebound on Friday night. And the 2-year, 10-year spread is still positive at 0.18, despite the media screaming that we must be heading towards a recession. Well, the bond market doesn't think so. And the bond market has generally smarter people than the media, and in fact, smarter people than the equities market. So I would tend to believe the 10-year, 2-year spread before I believe the media. So, just be careful what you consume. All right, let's go look at some other charts. So we'll start first of all with the S&P. And you can see the big intraday reversal, the big bounce off 3,800. Now, was that related to options expiry? Or was it the algorithms kicking in at 3,800, because 3,800 is a nice, neat Fibonacci retracement level from the COVID lows? There it is, spot on. 3808 is the Fib retracement level, the first level, and we got to a low of 38.10 on Friday night before we bounced. So is this bounce just merely coming off this level, or is it options related, options expiry related? Look, it doesn't really matter what it was. I think if you look at the charts of Amazon and Google and Microsoft and quite a number of others that are clearly in full retreat, then you'd have to say that this 3,800 level is at risk of breaking. And until we get some of those other things and some of the spread charts that I'm about to show you lining up better, then I've got to say that 3,500 on the S&P is in play. But I'm just totally open-minded on that. This is the QQQ, the NASDAQ ETF, and you can see we're clearly below the 20-day. We weren't even able to make it back to the 20-day. In a mild downtrend, these rebounds would make it to the 50-day, but they're not even getting close. If we look at the Russell 2000 for small caps, not too bad. And I must say I'm seeing a little bit of additional strength in the small caps. So hopefully once the large caps have done their thing and got washed out, the small caps may already be stabilising. So that, we could end up fairly promptly with the broad-based rally that I'm looking for, but, we're not there. Let's go to the spread charts because these, really tell the story. This is the NASDAQ versus the S&P. Despite the big rebound in the last 2 hours on Friday night, the NASDAQ is still falling. So growth stocks, money is still rotating out of growth stocks into defensives. Consumer discretionary versus consumer staples. We got a little bit of a blip, but it came off again on Friday night. So you can see we're still getting quite significantly lower highs and lower lows. And the little rebounds are very short compared to the previous immediate fall. Decent fall, small rebound. Decent fall, small rebound. So, we're still working our way down. This is Russell 1000 growth versus value. Still heading quite clearly to the downside. No sign yet of at the large cap growth side, money rotating back there. This is small cap growth versus small cap value. Little bit of a green shoot on Friday night, but you wouldn't want to hang your hat on that at this point in time. Okay, that's moving on to gold. So that is the situation with the US market and why I remain bearish in the short term. Turning to Aussie stocks, the Aussie dollar 0.6968 moved up a little bit. It was down under 0.68 during the week. Commodity factors took a bit of a break, took a bit of a back seat, and it was really just the impact of the US dollar coming back from around 105 back to 103. Our index managed to gain 1% across the week. It was quite a strong finish. The volatility was just incredible. Thursday down heavily, Friday back to the upside as the announcement about China easing their prime rate, and China has a bit of a history of easing in multiple areas. So I think we could possibly see some more easing announcements on Monday and Tuesday from China, and that's obviously going contrary to what's happening in the rest of the world. So the China property market, from what I can assess, is continuing to slide and is continuing to be in trouble. And that's why China is more concerned about their property market than they are about inflation and dealing with inflation. So if we move to the ASX 200, you can see just breathtaking volatility. That was the Friday before last. A couple of indecisive days, Monday and Tuesday, pretty solid on Wednesday, a shocker on Thursday, and then a huge rebound on Friday with that news out of China. So I have no idea what the Australian index is going to do on Monday, and we're fairly overweight Australian mining stocks, which is really where you want to be. And they had an exceptional day on Friday, which members know about. Okay, let's look at the US dollar. So there's the currency, but we're still clearly in a very, very strong uptrend, and our currency really just mirroring that. And we got down to 67.93 as the low point. 67.92 as the close, and 67.63 as the low on the Australian dollar. Moving on now to precious metals. Gold was up 1847. It took a big currency hit earlier in the week, but managed to recover as the US dollar came off. The Australian dollar gold price, in fact, I'm not sure that I updated that. I don't think that's a correct number. But the Australian dollar gold price is still looking pretty robust. It was a better week for the miners. GDXJ and GDX in the States looking a little bit better. So let's take a look at gold. So this gold on a weekly basis, so quite a useful rebound. And the daily chart looks thus. So the juniors very heavily sold off last week, but quite a nice recovery in the end. Turning to other commodities, copper edged up a bit, really just currency, and nickel somewhat similar, 12.58, which is still a very buoyant price for nickel. Crude oil rose another $3 up to 113. Individual energy stock trends remain sharply higher. So they're certainly indicating that the oil price direction continues to be up. And that's going to keep the upward pressure on inflation. There's the spot copper chart. You can see just the tick up here we've had over the last week. Similarly, the copper inventories, it's hard to see on this chart. This is a 1 year chart, but copper inventories did come off a little bit last week. That is a bit of a drop. And similarly with the nickel spot price. No change in nickel levels. So wrapping it all up, I think intuitively a lot of people know that the best opportunities occur when the news is at its worst. When there's blood in the street, when people are panicking to get out of the market. And I think we're heading towards that at a reasonable clip. My advice is to stay with stocks that have got strong earnings per share growth and they've got pricing power. Now, yes, you can own your developers in lithium and copper and nickel, and as long as they're an absolute quality project, with a world-class resource and a great management team, then yes, you can still own some of those stocks. Probably don't load up too much in the small cap area, but looking at the rest of your portfolio, there should be quite a heavy proportion of stocks that have got strong earnings growth. They're making a profit now because they're the stocks that the market really wants. They've really got to have pricing power. If companies don't have pricing power, they may well get found out by this inflationary surge because they're not going to be able to put their prices up. Their costs are going up, and that's what's happening, and that's why the US retail sector is getting smashed. Their costs have gone up. Supply chain issues have reduced sales, but they don't have pricing power. And so it's just killing their bottom line. So you've got to have pricing power because it's going to help you overcome the inflationary effects on that business. And everybody's going to get affected by inflation. We can't know for sure where the bottom is until a couple of months later. If you think you can pick the bottom within a couple of days, you're absolutely kidding yourself. So we only know for sure until a few months later. And if you wait a few months later until you're sure, then all the best of the rise is done. You've missed out and your risks are now a lot higher. So I believe that we can start judiciously buying the absolute quality that fits the portfolio composition that you want. And there's not some, gospel composition that everyone should abide by. It's up to each individual to figure out what is the sort of composition of your portfolio that is right for you. And I help members in my services, with that. And unless you've got a mechanism to think it through, talk it through, to decide what you want your portfolio to look like in 3 months or 6 months or 12 months, then, that ought to be a priority. And so I think it's not out of the question to start judiciously buying some of those stocks, even though we may still get a capitulation washout yet. Portfolio analyst last week focused a lot on how to play the rebound, and I also covered a number of fabulous large cap stocks in the States that I think most people have probably never heard of. So I think that was a session that was extremely well received. There's my details, website address, email address. For anyone that's not taken the Portfolio Analyst trial, I think you'll find there's a great deal of value in there. So worth doing, 2 weeks for $1, well worth the exercise. That's it for this week. By Sunday morning, we'll know the result of the Australian election. We'll know who's going to govern us and which policies are going to impact the stock market. And I'll be obviously talking about that to members over the next few days. So that's it for this week. Cheers.